All right. Today was the day, August 27th, Jackson Hole, Wyoming, actually a virtual meeting with the Fed. Jerome Powell spoke. And like I talked about, depending on what he says about the future of interest rate hikes, about the future of the Fed tapering their purchase of mortgage-backed securities, it's going to affect rates either positively or negatively. So I'll share a little bit of this video. I will spare you the 23 minutes that I drooled through and tried not to fall asleep listening to. And I'll just try to explain it in simple terms. That's what I try to do on this channel. So if you like straightforward content related to mortgage, real estate, housing, from a mortgage broker's point of view, everything that I see, talking to consumers, talking to real estate agents, listening to stuff like this and trying to put it in simple terms, consider subscribing to the channel, leave your comments below. I like the discussion. I like when I hear back from different people, different parts of the country with different views on what they think is going on. And I try to learn and listen as much as I'm talking, probably more. So without further ado, let's listen to my boy, Jerome Powell. Then I'll show you what you want to see, which is how these comments that he made have affected mortgage interest rates today and what we might see in the future. So let's listen to my guy.
The committee remains steadfast in our oft-expressed commitment to support the economy for as long as is needed to achieve a full recovery. The changes we made last year to our monetary policy framework are well suited to address today's challenges. We have said that we would continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals, measured since last December when we first articulated this guidance. My view is that the substantial further progress test has been met for inflation. There has also been clear progress toward maximum employment. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risks. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions. The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We have said that we will continue to hold the target range for the federal funds rate at its current level until the economy reaches conditions consistent with maximum employment and inflation has reached 2% and is on track to moderately exceed 2% for some time. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis.
All right, so let me try to explain that in layman's terms, what he is saying, because he said a bunch of stuff, and at the end of the day, could be somewhat of a nothing burger.
To hire?
Holy
hire
guacamole.
10 times more efficiently with Indeed hiring.
Apologies for that. I'm not going to go re-record this, though. This is how I do it. One take, no edits. So anyhow, Jerome Powell basically talked about, their inflation targets. And in the whole thing, he talks more about how he used the word transitory again, where he feels like inflation is transitory, but, the inflation targets, max employment and whatnot, and their reduction of mortgage-backed securities and how much they're purchasing. Because they're purchasing like 100 to 120 billion per month right now. And in layman's terms, they are going to do that as soon as the end of 2021, reduction of what they're purchasing, but they're still going to leave a lot of that on their balance sheet. So what that means is that it's going to be this slow unwind, right? There's not going to be anything drastic happening with interest rates. He also mentioned that, the tick up of interest rates, and actually this article is titled, No Rush on Rate Hike. Some people were of the mindset that as we see other countries ticking up their Fed funds rate, the US might do the same. He's saying it here that they're in necessarily no hurry to do that. And so that is more good news for people who want interest rates to remain low, right? While things in the economy look up and while employment is moving towards the levels they want to see to start taking up interest rates, he mentioned the Delta variant, mentioned that, that they're not going to be, they're going to be continuing to monitor, right? That's a sign for like, we ain't really doing nothing yet, right? And so, take that for what you will. But I basically took it as, hey, we like what we're seeing, but we're not seeing enough of it yet. We'll continue to monitor and we'll let you know next month, right? And so it's a little bit of a kick the can down the road as far as like what they're specifically going to do. And as you would expect, if they're like, listen, we're ticking up rates Q1 of 2022, and we're going to start tapering tomorrow. That type of talk would have mortgage interest rates go up. The type of talk like today, like nothing happening yet, and when we do, it's going to be slow. Mortgage rates got better. So I've shown this chart many times on this channel. This right here is basically green, meaning mortgage bonds getting better, rates down is what green means. And so 27 basis point move in the right direction, if mortgage rates going down is the right direction for you. Not a ton, right? For anybody who's like, oh my gosh, rates are down today. That's probably the headline too. Come Monday, mortgage companies galore and be like, Jerome Powell speaks and mortgage rates are down. Yeah, they're down 27 basis points, which equates to 1/2 of an eighth of a point move, right? Rates went from 2.875 to 2.812, whatever that is, right? And here's what today's move is basically, what are the dates here? This was last week, and up and down and up and down, and then a worsening earlier this week. And then we basically got that back. We got back what we lost on Wednesday for all intents and purposes, right? So really, trading within this pretty small range. What's this one? The 25-day moving average and the 100-day moving average. Look at how it like stays within that range, right? And so nothing really to report except for that this is probably a signal that we can expect for the time being rates to remain low. And I think that's, if you want to look at it from a real simplistic view and not dig into like, geez, Louise, I read some of these articles with some friggin' words that were really long. That's what we should see. Low mortgage rates, nothing drastic happening from the Fed until further notice. We'll continue to monitor. We'll continue to take a look. But for now, things are going to remain calm. So with that, if you have any questions at all and you're in California, I'm happy to help. Matt at mattthemortgageguy.com. If you're outside of California, happy to connect you with a mortgage broker I like and trust in the state that you're in. Greatmortgagebroker.com. Go fill out that form. One last thing I'm going to mention is finally, I've got the 11 or 12 videos for a Mortgage 101 course. The basic stuff, the not so basic stuff, how to save yourself some money on the next mortgage you do. That course is going to be available very, very soon. So I'm going to leave a link in this description. If it's not here by this weekend, I'll add the link next week, sometime around September 1st, when this course goes live. I think I'm going to do an introductory rate and try to give it away for next to nothing. Give me some feedback. Let me know what you think of it. It's intended to help consumers navigate and simplify the mortgage process, at least your understanding of it, right? So thanks for watching. I appreciate you. Until next time.